Welcome to the deep dive. You bring the source material, and well, we work together to figure out what's really going on inside.
Yeah, we unpack it for you.
Today, we're zeroing in on something that gets a lot of buzz, maybe some raised eyebrows too. Powering up your portfolio with potentially reliable dividends. We're talking yields over 10%.
That's the one. We've got an article here, Power Up Your Portfolio with Reliable Dividends, Yields Over 10%. And yeah, it makes some pretty big claims about finding these double-digit income streams that, aren't just going to blow up on you.
Right, so our mission really is to unpack what this article is actually saying. Are these yields for real? Can they actually be reliable? And maybe most importantly, what do you absolutely need to know before even thinking about this stuff?
Because look, a lot of people are probably feeling that pinch, right? Inflation, maybe returns feeling kind of sluggish. You want your money working harder.
Exactly. Tired of the leaky faucet, looking for the fire hose maybe. This idea of double-digit dividends sounds appealing.
Well, the article kicks things off by tackling what it calls the dividend myth. This idea that if it's safe, you're only going to get maybe 2% yield. Tops.
Like your standard blue chip or index fund.
Mm-hmm.
The article argues Wall Street's kind of trained us to accept that low number, but now...
Yeah, but with inflation doing its thing and the Fed, well, who knows what the Fed's going to do next week, right?
Oh, seriously. Trying to predict that is something else.
It is, and that 2%, it's just not really keeping pace, is it? It doesn't protect your buying power, let alone give you, meaningful income, if that's what you're aiming for.
Which brings us to the next big point the article makes. High yield doesn't automatically mean flaming garbage fire. That's often the gut reaction, isn't it? Anything over 5–6% must be dodgy.
It is, yeah. And the article really pushes back on that. Now, look, some high yield stuff is a disaster waiting to happen, no doubt. But the argument here is that there are also these hidden income machines.
Hidden income machines. Okay.
Companies with solid fundamentals, good cash generation, and they're actually committed to sending that cash back to shareholders.
So the trick is sorting the good from the bad, the reliable ones from the garbage fires.
Exactly. And the article lays out a kind of framework, a checklist, if you will, for vetting these high yielders. Think of it like checking the foundations before you admire the fancy paint job.
Okay, I like that. Let's walk through this checklist. What are we looking for?
First up, and probably the most critical, payout ratio. Specifically, the article suggests focusing on companies paying out less than 85% of their free cash flow.
Okay, free cash flow, not just earnings. And if it's over 100%?
Big red flag. Major red flag. I mean, they're literally paying out more cash than they're bringing in the door. That can't last forever, right?
Yeah.
Unless they're draining savings or piling on debt.
Makes sense.
Yeah.
But there are exceptions.
Yeah. The article points out specific structures like REITs, real estate investment trusts, and BDCs, business development companies. They often have to pay out most of your income, like 90% or more, because of how they're regulated. So different rules apply there.
Got it. So context is key, depending on the type of company. What's next on the checklist?
Balance sheet health. Got to look under the hood at their cash levels and, maybe more importantly, their debt. Is the debt manageable? Can they handle those payments comfortably? Too much debt can absolutely crush a company and its dividend, especially if things get tight economically.
Yeah, dividend paid for by borrowing more and more money isn't exactly reliable.
Not at all. Then there's cash flow consistency. Earnings can jump around sometimes, accounting stuff. But is the actual cash coming in steady?
Because dividends get paid with cash, not accounting profits.
Precisely. If the cash flow is all over the place, well, that dividend might be too. You want that steady, predictable flow if reliability is the goal.
Okay. And the last piece.
Management alignment. Are the executives eating their own cooking, so to speak?
Meaning, are they buying the company's stock themselves?
Exactly. The article sees that as a really strong sign. It suggests they believe in the future, they believe in the company's ability to keep generating value and keep paying those dividends. It's like they're saying, stick with us, you'll be glad you did.
Right. So the framework is payout ratio based on cash flow, healthy balance sheet, consistent cash flow, and aligned management. That's how the article suggests you filter for reliability.
Pretty much.
Okay, so with that filter, where does the article point us? It mentions some specific names, calls them the dividend beasts. Let's dive into those. Keeping in mind, these are just the article's examples, not our recommendations.
Absolutely, just illustrations of the concept. First one, Main Street Capital, ticker MAIN. It's a BDC, business development company, yielding around 10.2% when the article was written.
Okay, MAIN N.
Yeah.
And BDCs, they lend money to smaller companies, right? Kind of like banks used to.
That's the idea. They provide debt and equity to those small and mid-sized businesses. And like we said, BDCs have that requirement to pay out most of their income, typically 90% plus hour.
So the high payout is built in. But what makes Maine stand out according to this article?
Well, beyond just meeting the payout requirement, the article highlights its track record of actually growing its net asset value, NAV, per share over time.
NAV growth. Why is that so important for a BDC paying a high yield?
Good question. NAV is basically the company's book value per share, the value of all its loans and investments minus its debts. If a BDC is paying you that big dividend and the underlying value of its portfolio, the NAV is also going up. That suggests the dividend is sustainable.
Meaning they aren't just slowly liquidating the company to pay you.
Exactly. It suggests they're earning enough from their investments to cover the payout and grow the business value. Maine is also noted for sometimes paying extra, supplemental dividends, and keeping loan defaults non-accruals pretty low. Oh, and it pays monthly.
Monthly payouts definitely have a certain appeal. Okay, stop.
Yeah.
Energy transfer, ET, an MLP in the energy infrastructure space, yielding around 10.1%.
Yeah, ET. Think pipelines, storage tanks, processing plants. They own the toll booths for energy, basically.
Yeah.
Moving oil, gas, natural gas, liquids. They make money on the volume moving through, generally less sensitive to the actual price of oil or gas.
So more like a utility for the energy sector.
Kind of, yeah. What the article finds sexy about ET isn't its business, but its financials. Specifically, its cash flow coverage for the distribution is really strong, like over 2 times, even after reinvesting in the business.
So plenty of cushion there. They're generating way more cash than they're paying out.
That's the picture painted, yes. Plus, they've apparently been paying down debt, shoring up the balance sheet, and again, the article mentions significant insider buying. But there's a big but with ET.
Let me guess. It's an MLP, so taxes.
Bingo. Master limited partnerships mean K-1 forms, not your standard 1099. It can make tax filing more complicated. Now, some income might be tax deferred, which is nice, but paperwork.
Yeah. The article was pretty blunt about it, wasn't it?
It was. Basically said, if K-1s freak you out, maybe this isn't for you. You need to be okay with that complexity, or have a tax pro who is.
Fair warning indeed.
Oh.
Okay, moving on. AGNC Investment Corp, ticker AGNC. This one's a mortgage REIT and MREIT. And the yield is, wow, quite a bit higher, around 14.5%.
Yeah, AGNC. And the article is super clear here. This is not for the faint of heart. It's a leveraged MREIT. They borrow money to invest in mortgage-backed securities.
Which means they're very sensitive to interest rate changes. The last few years must have been rough.
Exactly. Highly sensitive. So why is it even mentioned? Well, the article includes it maybe to show a riskier end of the spectrum. It notes it was trading near book value at the time, which some might see as an opportunity if you think the assets are okay. It also mentions they've improved their hedging, and maybe importantly, management actually cut the dividend before things got really bad in past rough patches. Suggests maybe some pragmatism, but still, it's fundamentally a leveraged bet on interest rates and mortgages. Complex.
So the takeaway is high yield, yes, but high risk and complexity too. Definitely not core retirement money, perhaps.
That seems to be the strong implication, yes. Now, let's switch gears a bit to closed-end funds, CEFs. The article presents these as kind of under-the-radar income options.
Right, CEFs. They're noted for often trading at a discount to their NAV, sometimes using leverage, and yeah, often paying monthly income, sometimes over 10%.
Exactly. Think of them like mutual funds or ETFs, but with a fixed number of shares trading on an exchange. Because of that fixed share count, the market price can drift away from the actual value of the stuff inside the fund, the net asset value.
So you might buy $1 worth of assets for, say, 9 cents.
Potentially, yes. That discount is part of the appeal. They also often use leverage, borrowing money to try and boost returns, which of course also boosts the risk.
The article gives a couple of examples.
It does. PDI, PIMCO Dynamic Income Fund, yielding around 13.5%, focused on bonds and fixed income.
Okay.
And another one, CLM, Cornerstone Strategic Value, much higher yield, near 19%, more focused on stocks. But the article specifically points out that CLM's distribution often includes return of capital.
Return of capital, ROC. That sounds
Yeah.
potentially problematic. The article had warnings about CEFs too, didn't it?
It definitely did. They can be complex, sometimes hard to figure out exactly what they own or how they generate income. Fees can be high. And yes, the return of capital point is crucial. The article even warns some could be like glorified Ponzi schemes if they're just handing your own money back without actually earning it.
Okay, let's dig into that return on capital idea a bit more, because getting some of your principal back sounds like you're just spending down your investment.
It can be that, and that's the danger, what's often called destructive ROC. But ROC isn't always bad. Sometimes a fund might strategically distribute unrealized gains or use options income and classify it as ROC for tax purposes. This kind of ROC can be tax deferred, meaning you don't pay income tax on it right away. Instead, it reduces your cost basis in the shares.
So you pay the tax later when you sell.
Right. And if the fund is earning enough overall, maybe through total return, including capital appreciation, to support that distribution without the NAV constantly shrinking, then tax-deferred ROC can actually be beneficial.
But the destructive kind?
That's when the fund simply isn't earning enough income or capital gains to cover its high payout target. So it dips into its own capital base, its NAV, just to make the payment. You get the cash, yes, but the value of your investment is eroding over time. You really have to look closely at why a fund is paying ROC and what's happening to its NAV.
That's a really critical distinction. It's not just the yield number, but where that money is actually coming from.
Absolutely vital. Okay, one last example the article touches on. Oxford Square Capital, OXSQ. Another BDC, yielding around 11.8%. This one focuses on CLO, debt, and equity.
CLOs. Collateralized loan obligations. Sounds complex.
It is a more complex area of the credit market, yeah. Pools of leveraged corporate loans. OXSQ is described as smaller, maybe overlooked, maybe not as sturdy as some others.
So why include it?
Probably to show diversification within high yield. It offers exposure to a different asset class, CLOs, and despite maybe being more volatile, the article notes it has a history of pretty consistent monthly dividends, even through different market cycles.
Yeah.
It's presented as maybe a more niche, potentially higher risk-reward play within the high yield space.
Okay, so we've got BDCs and MLP and MREIT, CEFs. Quite a variety. It really sounds like jumping into this isn't just about picking stocks, but also having the right mindset.
That's a huge piece of it. The article talks about the psychology of high yield. These things can swing wildly in price. Seeing your investment drop 10, 20%, that's not unusual, especially when interest rates are moving around or the economy looks shaky. It takes a certain temperament.
Yeah, you could easily hit the panic button and sell at the worst possible time if you're just watching the stock price ticker all day.
Right. But the argument is, if your goal is the income, focus on the cash flow. Are the dividends still coming in? Is the company still covering them? That's the real money the article emphasizes, the income you can actually use. Focusing on that cash flow can help you ride out the price volatility.
Because the income stream was the goal in the first place. Okay, so if someone decides, yes, this high yield approach fits my goals, the article lays out a strategy, some key actions.
Yeah, a few core principles. 1, focus relentlessly on that cash flow, not the daily share price drama. Success is measured by the income hitting your account.
2, diversify. Don't put all your eggs in one high-yield basket. Spread it across different sectors, different types of companies, BDCs, MLPs, CEFs, whatever fits. One blow-up shouldn't wreck your whole plan.
3, keep tracking that payout safety. Use the criteria we talked about: payout ratio, balance sheet, cash flow coverage. Don't just blindly chase the biggest yield number you see. That's asking for trouble.
And 4, know what you're doing with the income. Are you readjusting it to make the income stream grow faster? Or are you spending it? Have a plan.
It definitely requires ongoing attention. It's not set and forget.
And speaking of attention, taxes. We touched on K1s, but the article has a whole section on tax talk. This income isn't treated like typical stock dividends, is it?
Generally, no. For REITs and BDCs, because they pass income through, those distributions are often taxed as ordinary income. That's usually a higher tax rate than qualified dividends.
Okay, ordinary income for REITs and BDCs, and the MLPs.
Those K1s again, complex. You might get some return of capital, which defers tax but lowers your cost basis. You might get ordinary income, maybe some capital gains. It's a mixed bag, and again, the filing is more work.
And for CEFs, that return of capital issue comes back into taxes too.
It does. If it's that non-destructive ROC, it can be tax-deferred, lowering your basis. But you need to track that basis carefully. If it's destructive ROC, well, it's still lowering your basis, but the underlying investment value is likely falling too. Understanding the source of the distribution is key for taxes and investment health.
So the bottom line on taxes seems to be:
get help. The article strongly recommends consulting a tax advisor, especially one who understands these specific types of investments: REITs, EDCs, MLPs, CEFs with ROC. Don't try to wing it unless you really, really know what you're doing.
Sound advice. Okay, one last crucial piece.
Yeah.
The exit plan. When do you sell? It's not about timing the market, right?
No, definitely not about day trading. It's about fundamentals breaking down. The article suggests triggers like the dividend gets cut and there's no clear, credible plan for how they'll fix the underlying problem and restore it.
Okay.
Or the company just stops covering the dividend with its actual cash flow consistently. Or the balance sheet falls apart. Maybe leverage just balloons out of control.
So basically, if the reasons you bought it in the first place, that reliable income stream based on solid fundamentals, disappear.
That's the idea. Conversely, the article says you hold if the price drops, but the dividend is still safe, still covered, the business model is sound, and the income is still doing what you needed it to do.
Because the goal wasn't quick capital gains, it was building that income stream.
Exactly. Look, this deep dive into the article shows it's a complex area, real risks, things you absolutely have to understand, like taxes and payout safety. But it also suggests a potential path to significant, maybe more consistent income than you'd get elsewhere.
It's maybe not the most exciting part of investing for some people.
Probably not. But the article's angle is that doing this right, focusing on that reliable cash flow, could make you feel, more financially secure, less worried about every market wobble or inflation report.
And the final word from the source really hammers this home. Do your homework. Research companies, compare them, actually read the reports, understand the business drivers, and please, diversify.
Yeah, diversify, diversify, diversify. So one company cutting its dividend doesn't sink your ship. The article frames it as building your own personal pension, a reliable cash flow stream you construct yourself.
A personal pension. That's an interesting way to put it. So maybe the final thought for you, the listener, is thinking about your own goals, your need or desire for reliable income. What does that idea of building a personal pension mean for your next steps? How might you start to really understand if these kinds of investments, with all their complexities, fit into your picture?
Because the article really suggests the best dividend isn't just the highest number flashing on a screen. It's the one that actually shows up reliably month after month or quarter after quarter. And finding that, that takes some real digging.